All right, let's dive right into this. Welcome to The Explainer, where we take all that abstract economic jargon and translate it into everyday Zambian reality. If you're a young adult, a student, or really just anyone trying to navigate your finances in Zambia today, you probably hear terms like inflation, interest rates, and liquidity thrown around on the news all the time. But what do they actually mean for your wallet? In this explainer, we're going to break down 14 essential financial concepts using real Zambian examples, so you can make much smarter decisions with your money.
Let's kick things off with a story. Meet Mwamba. She's a 32-year-old teacher living over in Dola. Back in 2020, Mwamba was earning a salary of 6,800 kwacha a month, which felt pretty comfortable at the time. Fast forward to 2024, and her salary goes up to 7,500 kwacha. On paper, she should be celebrating, right? I mean, she got a raise.
But here's the thing. Mwamba is definitely not celebrating. Even with that raise, her grocery bill absolutely skyrocketed, and her monthly savings plummeted from 1,800 kwacha all the way down to a mere 200. She's looking at her bank account, scratching her head and asking, wait, my salary went up, so why does it feel like I'm earning less? It's a really frustrating mystery.
So to solve Mwamba's mystery and empower your own wallet, we're going to unpack these 14 financial concepts across 5 distinct areas: why you feel poor, the true cost and power of money, how to make smart money choices, the big economic picture, and what the kwacha means for your future.
All right, part 1, let's look at exactly why you feel poor and track down the invisible thief hiding in your budget.
The main culprit here, inflation. That's our first concept. It's basically the rate at which general prices go up over time, and it absolutely destroyed Mwamba's purchasing power, which is concept number 2. Purchasing power just means what your money can actually buy. To put this into perspective, back in January 2020, a bag of mili meal cost 90 kwacha. Fast forward to January 2024, that exact same bag is 160 kwacha. That's a whopping 78% price jump in just 4 years, driven by things like fuel costs, a weaker kwacha, and those electricity shortages we all know too well.
And this perfectly illustrates our third concept, the huge difference between nominal value and real value. Think of nominal value as just the ink on your paycheck, the face value. Real value, though, that adjusts that number for inflation. So yeah, Mwamba's nominal income went up about 10.3% to 7,500 kwacha, but cumulative inflation over that exact same time was hovering around 65%. Her real value totally tanked because her higher salary actually buys 37% less real goods, like those bags of mili meal.
Okay, moving on to part 2, let's talk about the cost and power of money, specifically the hidden mechanics of borrowing and growing your cash.
Here's concept 4, interest rates. Simply put, this is what it costs to borrow money or the reward you get for saving it. In Zambia, lending rates usually sit around 25 to 35%, while savings give you maybe 4 to 9%. Now, all of this is anchored by concept 5, the monetary policy rate, or MPR. The Bank of Zambia sets this foundational rate to keep inflation in check. Notice how back in 2020, when inflation was low, they slashed the MPR to 8% to get the economy moving and make borrowing cheaper. But as inflation shot up, they had to raise it aggressively, hitting 14.5% in mid-2025 just to cool down spending. Now, looking at 2026, it's being dialed back down to 13.25%. Basically, whenever the Bank of Zambia moves this rate, your local commercial bank follows right along, which directly changes how expensive your car loan or business overdraft is going to be.
But hey, when you're saving instead of borrowing, interest actually works for you. This is concept 6, compound interest. Literally, interest earning interest. Check out this incredible comparison. Grace starts investing 500 kwacha a month at age 22. Bwalia invests the exact same 500 kwacha, but he waits until he's 32 to start. Assuming a 15% return, by age 60, Bwalia has a respectable 3.4 million kwacha. But Grace, because she started just 10 years earlier, she retires with over 15.2 million kwacha. That's more than 4 times the wealth for the exact same monthly contribution. That is the sheer power of compounding time.
Which leads perfectly into part 3, making smart money choices and how to actually evaluate the options sitting right in front of you.
To make your money compound successfully, you have to grasp concepts 7 and 8, risk versus return, and liquidity. Think of every asset as sitting on a spectrum. An MTN Momo wallet, or just plain cash, is perfectly liquid. You can access it instantly, but it offers almost zero return and no risk. Step up to government treasury bills, and you get a solid, low-risk return, right now yielding around 10.5 to 12.5%, while still being pretty liquid.
Then you have Lucy shares, the Lusaka Securities Exchange. These carry more risk, but offer higher potential returns. And property? Sure, it might have great long-term returns, but it is highly illiquid. You can't exactly chop off half a plot of land and sell it overnight if you suddenly need cash for a medical emergency.
Understanding these risks ties right into concept 9, diversification. We've all heard, don't put all your eggs in one basket. Well, let's talk about the Chilemba trap. A Chilemba, an informal savings group, can be a brilliant piece of your financial puzzle because it forces you to put money aside. But if it's your only plan, that is incredibly dangerous. It represents a total lack of diversification. If the group organizer suddenly vanishes, your entire safety net is gone. You've got to spread your money across different vehicles, like savings accounts, treasury bills, and eventually property.
And that brings us to concept 10, opportunity cost. This is the hidden cost of what you could have done with your money instead. Say you keep 20,000 kwacha safely stuffed under your mattress. It feels secure today, for sure, but the opportunity cost there is absolutely massive. By hiding it, you're missing out on roughly 2,500 kwacha in treasury bill returns over a single year. Plus, with inflation quietly eating away at it every day, the real value of that mattress money actually falls. Literally every choice you make has a cost.
All right, let's zoom out a bit for part 4. Let's look at the big economic picture and the macro forces sweeping across Zambia.
Concept 11 is one you interact with every single day, supply and demand. This one rule explains almost every price tag you see. Have you ever wondered why tomato prices in Lusaka suddenly doubled during load shedding? It's not because farmers just decided to get greedy. It's because those power cuts disrupt cold storage and transport, meaning the actual supply of tomatoes suddenly drops. Demand stays exactly the same, but supply plummets, and boom, prices shoot straight up.
Speaking of macro forces, let's look at concept 12, the budget deficit. This happens when the government is spending more money than it's pulling in from taxes. To cover that gap, the government has to borrow heavily. So, why does this affect your daily life? Well, when the government is borrowing up all the available money in the system, banks have way less to lend to regular everyday businesses. In economics, this is called crowding out private credit. It pushes commercial interest rates up, making it much harder and more expensive for you to get a cheap loan to start or grow a business.
All these government choices feed directly into concept 13, our gross domestic product, or GDP. Think of GDP as the total monetary value of everything produced in the country. In 2024, Zambia's GDP was sitting at roughly $28 billion US, and a huge chunk of that is driven by global copper prices, agriculture, and tourism. So when copper prices dip on the world stage, our entire local economy feels it. Government revenues drop, the currency gets weaker, and eventually it hits your own pocket.
Which brings us to our final section, Part 5, the kwacha and your future.
Let's talk about concept 14, the exchange rate. The kwacha against the US dollar is probably the most obsessively watched financial metric in Zambia. And man, it has been volatile. Back in 2012, it was about 5 kwacha to a dollar. By early 2025, it had weakened all the way to 28 kwacha per dollar. But look at July 2026. The exchange rate strengthened dramatically, bouncing back to 18 kwacha per USD. That is genuinely great news. Supported by copper mining inflows and debt restructuring, a stronger kwacha means imported goods get cheaper, which directly helps cool down that inflation rate we talked about at the start.
But for everyone to actually feel the benefits of a stabilizing economy, we need to look at a final bonus concept, the formal versus the informal economy. Right now, an estimated 50 to 70% of Zambia's economic activity is completely informal. We're talking about the hard-working traders at Soweto Market, the minibus drivers, the roadside vegetable sellers. These businesses are cash-based and super vulnerable, operating without social protection or access to formal banking. Empowering these workers with real financial literacy so they can transition into formal, protected financial tools, that is absolutely essential for the country's long-term growth.
And that wraps up this explainer. You now know the hidden mechanics of money here in Zambia, from inflation stealing your purchasing power to the magic of compound interest, right up to the macroeconomic impact of the kwacha. So I'm going to leave you with one final provocative thought. The next time you make a financial decision, whether it's keeping cash in a Momo wallet or joining a local Chilemba, ask yourself, what opportunity cost are you really willing to pay today to secure your financial tomorrow? Thanks for tuning in, and keep making those smart money choices.